Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Now, let's start the program. This webinar is the second session of the It's Your Money workshop series. The topic of the day is Financial Planning Part 1. Our moderator is Peter Coates. Our guest speaker is Thomas Anderson. And this webinar is brought to you by Chapman University. Enjoy the workshop.
All right, Thomas, come on board.
Good morning, everyone.
Good morning. Hey, Thomas, we're going to do financial planning 1, but before we get there, let's just quickly go through your Ask First form. We're not going to go into the depth that we did in the previous session, but let's just point out some important things. And one of them is you have a CFP, correct?
I do not actually have my CFP designation yet.
But yeah, how close are you?
So I've passed the exam, and we'll talk about like all the things that are covered in the CFP a little bit later, but there's an education component. So I've gone through the education component through UCLA. I've done the exam, which is a pretty rigorous exam. It's like 6 hours long. It's pretty brutal. And then the last thing is to get 3 years of experience. And so I'll have my third year of experience in hopefully September of this year.
And who do you work with to get that experience?
Yeah, so I'm working underneath another CFP. The company that I'm working at is called Have a Plan Financial with a woman named Lori Dubchansky. She's done quite a few of these financial literacy presentations, and so you might have seen her on here before. So I've been working with her for this entire duration of 2 years.
You know, one of the things that people think is that you have to have big money in order to use a financial planner. Is the process any different for somebody who has a 20 million versus somebody who has 100,000?
So it depends on the financial advisor that you're working with, but
the process is pretty much the same.
The process is the same, but I think, yeah, it just depends on the fee that gets charged and the minimum set up by that financial advisor.
Yeah, but what we're going to go through today, whether you have 100,000 or 10 million, you're going to do it yourself or somebody else. The process is the important thing. You gotta go through it. I noticed that you don't have any licenses. What does that mean?
Yeah, so I don't have any licenses noted here. So that would include maybe, I guess, not credentials, but licenses. So I'm not an attorney. I don't have my securities license. If you have a CFP, you do have some of those licenses built in. So if I get the CFP this September, I will have some of those security licenses built in. I don't have an insurance license because at our firm, we don't sell insurance.
Right. And you don't sell securities either. So that's the good news. So not having licenses is really a positive. A Series 6, Series 7, you could sell securities, you could sell mutual funds. So I prefer dealing with a financial advisor who does not have a license. Let's scroll down a little bit. You are a fiduciary to your clients. You put your best interest as far as their interest first, and then how do you charge your client?
Yeah, so the way I'm paid there is salary via Lori, but Lori charges in our company either an asset under management fee, which that fee is 0.5%. Or we charge an hourly rate, which is $300 an hour. And for the hourly, it could be, project based where it's 6 to 10 hours. But the important thing is in both the asset management and that hourly, we're charging a fee for our services. We're not charging a commission from selling a product. We're only working for a fee.
Okay. So asset under management, do you have a minimum?
We do not have an asset minimum. We are willing to work with anyone, but I think it's a conversation. It's to see if it's a good fit still. So yeah, we're willing to have that conversation with anyone, regardless of their asset size.
And do you offer a free look or somebody just, I'm not sure if I want to be with you. Can you take a look and see what you can do for me?
Yeah, absolutely. So I think that's the way we like to start. We do a 30-minute introductory phone call just to get to know each other. It's to see if we're a good fit because a financial planning, it's a relationship at the end of the day. And so we want to see if you're a good fit with us and if we are a good fit for you. Are we the right type of advisor that you want to work with? Do we charge in the right way that you want? Yeah, can you trust us? And so I think
Yeah.
we try to establish that in that first call without
Uh,
charging anything.
Approximately how many clients do you have?
Yeah, we have about 60 clients we manage assets for. And
And
then we kind of have a rotating amount of hourly clients because,
they're hourly.
people come in for a project and then they might disappear on us for a year. But
Yeah. You're one of the few fee-only fiduciary advisors in Orange County that'll do hourly. So hope you guys continue to do that.
yeah,
Because
I think it's a niche for us
yeah,
because it allows us to work with anyone, regardless of their asset size.
yeah.
Um,
Who's your custodian?
Yeah, we custody our assets at Charles Schwab. And for
Yeah,
people on the call to understand what that is, a custodian is, you could think of as like the middleman between us and your investment assets. So we don't hold people's investment assets directly. Those assets are held at the custodian Charles Schwab, and we just have a limited power of attorney to make trade decisions on that account at Schwab. Um, yeah, so it's a
yeah. And you're not associated with anyone who sells annuities, insurance, mutual funds, and you don't take or give referral fees.
No, yeah, we don't sell any products like that. We still like to have these conversations because these things still come up in comprehensive financial planning, particularly insurance. If we're, reviewing liability insurance like home, auto, those types of things, that's still going to come up in financial planning, but we don't sell a product. We might refer someone out and say, you should go talk to this agent and see if you can get a competitive quote. But we don't get a kickback from any kind of referral like that, nor are we
Yeah.
selling any type of product.
And by the way, that is really common in the financial services industry to get kickbacks, to get commissions, to, be careful. If I usually ask if somebody makes a referral, are you doing this for a fee or is this somebody you believe will help me uh, get what's in my best interest? So be careful. Thomas, let's go to your outline. Let's get started.
Let's do it. Switch over here. All right. So today we're going to be talking about financial planning one. So this is going to be an introduction to financial planning, really covering these three topics: who is a financial planner, why you should have a financial plan, and what financial planning is. And to give a little bit more background on myself, I actually started out as a mechanical engineer. I went to Cal State Long Beach for my undergrad. Um, After my undergrad, I worked for 5 years as a professional engineer. And then I started researching these questions because I myself was very interested in the financial planning world, but I actually didn't even know it was an industry itself. I was kind of Googling, how can I help people with their finances? And this career path came up. And so I started doing a really deep dive into these things to try and find out what type of financial planner I'd want to be and what type of financial planning company I'd want to work with.
You know, you having an engineering background, it's literally perfect for the financial planning world because there is so much number crunching that you have to do. It's uh, it's not about how smooth you can talk. It's about literally getting into the numbers and trying to figure out what is the best avenue for the individual. So, can anybody call themselves a financial planner?
Yeah, let's jump to that. So, unfortunately, the answer is yes. Um, so the financial planner name doesn't have a legal meaning in the same way that you might hear like doctor or an attorney being able to use those legal names. And you know that there is a credentialing process that requires experience, requires education. Maybe there's an authoritative body behind it. There is not that same um, level of diligence with the term financial planner or any of these terms that are up on the screen between advisor, consultant, wealth manager.
Thomas,
Those.
what do you like to use for yourself?
So I call myself an associate financial planner, and
Okay.
I don't even have my CFP yet, but I am still able to put that on a business card. So I think the important thing is the name on the business card doesn't necessarily dictate authority.
Yeah.
It's really important to dig deeper. That's what that ask first form is really good at doing. It digs deeper than just saying, "Oh, this person has financial advisor on their business card. I should trust everything that they're saying."
You know, not speaking about business cards, if you were a broker, you would have to have on your business card your association with FINRA on that business card. Whereas for you and your firm, it's not needed because you don't sell product.
True. Yeah, that's a good point.
There's are you? Let's go to the next slide.
Okay.
Yeah,
Yes.
here you go.
Yeah, so these are all the places that a financial planner could work at. And so, like I was saying, when I was first looking into this field, I was doing the research on all these different types of companies to try and determine where would I want to work at? Where would I want to work at where um, I can work as with little conflicts of interest as possible and deliver advice that is in the best interest of my clients.
So for example, you work with Lori, and so she is an independent registered investment advisor.
Yes, she is an independent registered investment advisor. So the other term you might hear a lot is RIA.
Yes.
Um, so
And
that just
then and
that
then an independent broker dealer would be a Schwab. Would that be an independent broker dealer or Merrill Lynch?
yeah,
Uh,
we could kind of combine those two, the independent and wirehouse. But yeah, it's a much bigger firm where typically the financial planner who's working there is recommending the products that company has created. So if you think about like a Wells Fargo, if you have a financial planner working there, then they're probably going to be recommending the products that Wells Fargo has created. And there's typically they're incentivized, like their income might be based on selling the or commission coming from those products.
well, like for instance, Bank of America bought Merrill Lynch. So Merrill Lynch is now located is a wirehouse broker dealer, and they're located within a bank of Bank of America. So all of these institutions, except for a trust company, or except for the independent registered investment advisor, sell products.
Right. Yeah, and I think touching on the bank, I an example I like talking about is so if you were going to go work with an advisor who is at a bank and you were working with this person and they might recommend a loan to you and you have to ask yourself, is the loan they're recommending for this house that maybe you're going to go purchase, is it in the best interest of the bank or is it in the best interest of yourself? And oftentimes when there's a product on the line between the two of you, then it's often in the best interest of the bank. And so that's something to look out for is just ask yourself, how is this person being compensated? And who are they looking out for? Are they looking out for the best interest of myself, or are they looking out for the best interest of the company they're working for?
Yeah. Many people have accounts at credit unions, and credit unions do a phenomenal business selling commercial annuities. Um, you know, those commercial annuities have huge commissions in them. And, these products that's how the revenue is created through commissions. And it might not, more than likely, an annuity is not in your best interest, except we're talking commercial annuity, not a charitable gift annuity.
Right.
Um, you know,
And an unfortunate part of that is it makes the relationship very transactional, especially with an upfront commission. You can imagine if a person gets paid right up front, they're probably not going to be looking out for your best interests going forward. They're
but people are used to going to see a financial advisor to, for the investment only.
Yeah,
They don't. We're going to go through that. You shouldn't do that before you invest. You need to know a few things. But I'd say the majority of individuals do not understand the financial planning process.
yeah, I think that's a great point. So I think, yeah, we'll dig into the financial planning process a little bit later. But
Yeah,
yes, oftentimes if you go work with an advisor at one of these places that's more product heavy than service heavy, the first conversations are really about the investment product
yeah.
themselves.
How much? How
Really about,
much? What's the yield? What's that type of
yeah,
thing, and how risky is it? And that's the conversation.
yep. Yeah, and it's not necessarily about your own financial circumstances and understanding who you are. It's more about educating you on a product that they want to sell.
Yeah, it's kind of like buying a car. Let's
Yep.
go to the next slide.
Yeah. So we've been talking about this a little bit, but these are the different ways that financial planners get compensated. So to start, commission, this could be from selling anything like a mutual fund, an annuity
Limited
product,
partnerships.
yeah, an insurance product like life insurance. Um, so that's a more transactional relationship. It's a product. It's not necessarily a service. And it can often be like a one-time thing. You
Yeah.
sell you into a product. There isn't necessarily an ongoing relationship. It's just a one-off thing.
Fee based.
Fee-based, that could be a tricky word because it sounds closer to fee only. But the unfortunate part is fee-based is a combination of commission and fee only. So that could look like someone who is a maybe fee only RIA like Lori and I are, but then they also have their insurance license and are selling like a life insurance product.
It's very, very difficult to determine how much you're paying if you're with a broker. I've had CFPs, I've had CPAs. I myself have tried to figure it out when somebody brings a statement into me to review. But the average industry wide is approximately 3% annually. Yet it's very difficult to determine how that 3% comes about because the fees and expenses are hidden within the products.
Yeah, and that's an unfortunate part. So I think oftentimes when you get an investment statement, you won't get these fees very detailed out, and it'll tell you, oh, this is all the things that were charged. These are all the transaction charges that happened. Like Peter's saying, it'll be wrapped up into the fund itself. So let's say the fund would have performed at 6% return, but the fees themselves inside the fund were about 2%. Then what you might see on your statement is the fund returned 4%, and it would be hard for you to kind of like back into to find that 6% number.
Yeah.
Uh,
Yeah.
You
Whereas
got to be aware.
on a fee-only advisor, does your firm give out a quarterly statement showing what you are charged, what you
Yes.
charge the client?
Yeah, so that would be the next one here, which is the fee only based on asset under management. So if you're working with an advisor and they're charging an asset under management fee, the typical way it's charged is it's charged quarterly and it's charged on the balance of your investment account at the end of that quarter. So let's say, imagine at March 31st, your account balance is $1 million, and over the course of the whole year, the fee is a 0.5%. Well, a 0.5% divided by four for the 4 quarters is 0.125%. So 1250 is what would be then deducted from $1 million account at the end of that quarter, or
And
March
and
31st.
and it's simple and it's understandable.
Yep, and it would be very transparent. It gets documented, it gets sent out. You can see the fee very clearly deducted from the account. It's a very transparent process.
Yeah. What is
So
a retainer model?
yeah, a retainer model could be you're working with an advisor and you agree that, let's say, over a course of a full year, that advisor is going to be working with you, and you determine maybe it's in a range of $3,000 to $5,000. Let's say that I'm going to pay you this lump sum either now or spread out over a course of a quarterly, monthly, and that advisor is going to be my advisor on retainer to be able to help me over that period of time.
I see that a lot with individuals that have real estate, because real estate is a little bit hard to value on a quarterly basis, and so uh, the they come out with a retainer model where they agree to a set sum, and it's a good way of working with one another for your particular situation. And then fee only on an hourly basis. Um, People sometimes just kind of need a tune-up to see if what they're doing is appropriate.
Yeah, and so that's often how we work with people is we hourly works really well, especially for those who are DIY, who really just want like a second opinion to review their retirement plans. So we still do a full comprehensive plan with them. Takes maybe 6 to 10 hours to go through, including the time that we're meeting with a person. And then after that initial, amount of hours is spent and used creating the financial plan, it could be that there's an annual or semi-annual check-in that's an hour here, an hour there, that allows that person to keep coming back and getting financial planning advice, but it doesn't have the same type of commitment that assets under management or retainer model might have.
When I was working at Long Beach State University, they gave me kind of a quarter-inch benefits booklet. I had 110 different companies to choose from for my 403B program. When you leave Long Beach State University, there's another bunch of choices that you have to make. You know, to meet with an hourly individual to help you make those decisions is so worthwhile, because whatever decisions you're making, it's you can't go back and change it.
Right. Yeah. And it's unfortunately a lot of financial terminology and processes have become more and more complex over time.
Yeah,
And
and
where it
most of
might,
your and most of your institutions and employers are employer driven. They're not employee driven. So their employers want to make sure that they don't get sued and they're not liable for anything. So they want whoever is handling your pension plan or your 401k, they want to push that liability to that carrier. And consequently, the charges, the fees are much higher. So a lot of times it's to your benefit to switch over to a IRA account from that employee driven plan.
yeah, yeah. And that's something that in the hourly model, yeah, we are able to review pretty quickly. And then just it can be an engagement just surrounding, leaving an employer and all the different things you got to do. Maybe
Yeah.
it's before a
Insurance is another big area, you know. So at some particular point in time, you may not need the insurance that you have, and you got to feel good about letting it go, you know. And it just pays to be able to check out something with a person that has your best interest at heart. That for that hour, they're only working for you.
yeah.
Let's go
And
to the next slide.
I think the other good thing about hourly too is it's kind of like allows you to test the water of getting financial planning advice without the full commitment of doing either retainer or asset under management model. So if you want to, see if you can establish that trust over just working hourly with a person and then decide, okay, I do trust this advisor, I trust the recommendations they're giving. I'd like to switch to an asset under management. That's also a good way of
I
doing it.
love the little box that you guys put in on the right-hand side of the screen as you're looking at it. What does duly registered mean?
Yeah, duly registered would mean someone who is a RIA, so they're a registered investment advisor, but they also are associated with it as a broker dealer. So they're doing both, charging a fee quarterly for the assets under management, but then they're additionally charging a fee for the transaction costs or the products themselves, investment products themselves that they're recommending.
Yeah.
Um, yeah.
Yeah. The other thing too is that the fee-only advisor and they have an insurance license. We would not allow individuals to present who have an insurance license. And why? I mean, why don't you have an insurance license? You can make a ton more money.
Yeah, it's a conflict of interest because selling a product creates a conflict and it creates an incentive that doesn't allow you to necessarily put the client's best interests at heart.
Yeah.
It's not necessarily to say that anyone selling insurance is a bad person. It's just the incentives are aligned. Incentive is a big term. Incentive is aligned so that that person can benefit from the product sale.
Yeah, yeah. That's why we like you to use the Ask First form. Is so somebody who's multi-licensed in securities and insurance, real estate, those are not credentials. Those are individuals that work on commission, and that's not what you want. Let's go
Yeah.
to let's go to the next slide.
Yeah, and when you're working with an advisor and you're asking using that ask first form, how are you charged? And if they're giving you a really, really long answer, it's probably not great for you. So
Yeah, it
when
should be
you ask that
short and
question,
sweet.
yeah, it should be short and sweet, that's for sure. Um, so these are the different credentials that you also might see on a business card for someone saying that they're a financial planner or advisor. So first was CFP, Certified Financial Planner. We talked about that a bit. It has a rigorous exam, education requirement, an ethics requirement. Um, the biggest thing with the Certified Financial Planner Gold Standard is it requires that all of the members who hold that designation act as fiduciaries, which is acting in the client's best interest at all times instead of their own. So that's
But
why
just
that,
like, but remember, just like a doctor can work for a sleazeball outfit and sell you supplements, product. Just because somebody has a CFP, you got to do a little bit more inquiry than just that they have a CFP. That's
absolutely.
just the
Like,
beginning. It's a start.
yeah, we've been going back to that a lot, but the Ask First form I think is great because it kind of walks down through. It's not just do you have a designation, okay, that's great,
How many
but
years experience do
how are
you
you
have?
charged? How much
Yeah.
experience do you have? Yeah, it really like lets you know more about that advisor.
Yeah.
So some of the others on here, chartered financial consultant, that's actually very similar to the CFP. They don't
But
have the same fiduciary
yeah.
standard
It's from
though.
the insurance industry.
Yeah. CPA, so that's if you're working with your tax preparer and they're a CPA, they might also have on their title that they're a personal financial specialist. So that requires some education similar examination for them to have that title. Pretty much says that they're somewhat competent.
Yeah, but you need to ask, do
Yeah.
you work as an accountant or do you work as a financial advisor? If they say they do both, I would really be skeptical.
Right. And then the last one on here, chartered financial analyst. So that also has a lot of the rigor that a CFP has, except it's really, really a deep dive. It's like a mile deep just on investments. And there isn't much touching on financial planning itself. So a person who has the CFA designation is typically going to be seen working at like one of those big institutions helping run a fund, or if they're doing investment management for you, they're probably only focusing on the investment side. They're not necessarily focusing on the other financial planning pieces that we'll talk
They're
about later.
they're good stock and bond analysts.
Right.
Then you've got talked about experience. Talk a little bit about the rapport.
Yeah, I think this is probably the most important, maybe of everything here, is just the trust that you establish with your advisor. So when you're working with the advisor, it is a relationship. Ideally, it's a long-term relationship. And if with any long-term relationship, you want to make sure you have trust. And so building that trust and making sure that this is a person that you want to work with, that you're excited to work with, is super important. So sample out a lot of advisors. There's great websites to find these fee-only advisors out there, and sample a few before you commit to one person.
Right. Suitability versus the fiduciary. What does that mean?
Yeah, so if the fiduciary is acting in a client's best interest at all times, ahead of the
And if
advisors.
they don't, look, are they liable?
Yeah, I mean, maybe you could speak to some of the liability parts of it, but there is consequences to it, especially the CFP board has their own requirements. They will strip that title from someone if they're not acting as a fiduciary. The suitability.
Yeah, good. The way I look at it is that there's probably 20,000 plus mutual funds out there. Probably most of those funds are suitable.
Right. Yeah. So that's the suitability. It's
but certainly not most of those funds are in your best interest.
Exactly. That's a great way of putting it.
You know,
there could be two funds, like let's compare two S&P 500 funds. Both would technically be suitable. One might have a 1% fee attached to it, and one might have
no fee
attached to it.
Yeah.
Both products are identically suitable for the client, but one is clearly in their best interest. The other one is just suitable for that person.
So most of the brokerage business, Merrill Lynch, Morgan Stanley, LPL, Commonwealth, Ameriprise, are under a suitability standard. If so long as the product is suitable for you, they cannot be held liable for their actions. Whereas under the fiduciary model, is that if they don't do what's in your best interest by picking that right mutual fund, they become liable. Totally different standard, totally different cultures. I think the fiduciary service model is a vocation. I see the suitability market as more of a sales culture atmosphere. And there are ethical people on that side. We call it the dark side, but there are ethical individuals in there, but the culture is completely different.
Yeah. Yeah. And I'm really glad that that's a line on the Ask First form. I think I brought it up a few times, but I think that form has got to be with you when you go meet with a financial advisor.
Yeah, and it takes 3 to 5 minutes to complete on the professional's part.
Yep. And you keep it in front of you and you just ask those questions.
Yeah. Independent custodian. We want to avoid the Bernie Madoff.
Yeah. So the Bernie Madoff scenario Peter's mentioning is a situation where the advisor is holding your assets directly with themselves. So that's someone where when you're cutting a check to them or you're transferring funds, you're transferring directly to their account. And there are a ton of risks in that situation because, like a Bernie Madoff, they could run off with those funds, they could misreport your actual returns. There's a ton of risks involved in that. So what you want is someone who has an independent custodian. Like I was mentioning earlier, that's a middleman. So when you're working with a client, like when we're working with a client, Schwab is our custodian, Schwab is that middleman. A client's accounts are at Schwab, and all we can do is see the accounts, make trades on the accounts. But if we ever, and we can bill our fee from that account, but any type of wire, any type of transfer from the account always has to be approved by the client. It's always on the client's end. We can't just be taking money from the account. We can't just be transferring money to ourselves.
Yeah.
That middle is super important.
Yeah. There's scams every single day in the news, in the financial news, and multi-million dollars. And it's mostly in Laguna Beach. There was one just a year ago. Somebody didn't use an independent custodian. If you buy a limited partnership share, you are giving that money to the general partner, and there is no third party overseeing anything. It's we should call it "It's Your Money," and everyone wants it. It's the independent custodian is I don't think gets the proper recognition that it should. Make sure you don't give the monies to the person who's helping you out financially.
Exactly. Totally
Let's
agree.
go to the next slide.
Okay. So now we're going to start getting into why you should have a financial plan.
Whether you're going to do it yourself, whether you have a 10 million or whether you have 100,000, you need to follow these steps.
Yep. And I think it starts with defining your financial goals. So like Peter's saying, whether you're doing it on your own or you're working with a financial advisor, you want to clearly define, like, what are you actually saving your funds for? What are you investing your funds for? And that starts with defining your financial goals, defining your values. A good financial advisor is going to start with that rather than jumping right into any kind of recommendation. They're going to first want to understand you and understand what are the primary motivations that you have.
Yeah. Are you worried about inflation? Are you worried about cash flow? Are you worried about your standard of living? Are you worried about wanting to travel more? Are you worried about funding your kids' education? Are you worried about your grandkids' education? Do you want to die with a high net worth number? Do you want to make sure that you don't run out of money before you die? You gotta let either yourself know or somebody else know what are those goals. Write them down. 3 to 5 is usually what I hear. If you do more than that, it becomes you need somebody to help you redefine them or to narrow them down.
Right. And then after you documented those goals, you want to make sure they're realistic, and then you want to give a timeline to them. You want to be able to make them time bound. Like if you're saving up and you want to retire in a couple of years, making sure you have enough assets for retirement in a couple of years. Like making sure your goals all have a timeline, are all realistic.
Because we don't live till 200. How long do you guys have in your plans? How long do you have your clients live till?
We're typically having clients to 95, but we talk about longevity with all of our clients. If we have clients who have health concerns and have health issues, maybe the longevity is lower. If we have clients who have parents who have lived, into their hundreds, of course, we're extending longevity. So we kind of baseline start at 95 and then we move it up and down based on the person.
Yeah, because it's a number crunching exercise.
Right. And of course, if the number is longer, you have to fund a longer retirement. So yeah, that's a really important thing to ask yourself.
How much can you spend on an annual basis?
That is a super important one. So for spending, I know budgeting itself is a scary word, so we don't necessarily like that word, but at least documenting what are you currently spending? Like where do you currently allocate your resources to? And I think a great place to start with that is at least what are the committed expenses that you have every month?
Yeah,
So I like to
we're really creatures of habit, in your experience, can you make a spender into a saver, or vice versa, a saver
hard.
to a spender?
It's hard, but
Yeah,
yeah, we are creatures of habit. So people, if you've been saving your whole life,
yeah,
um, it's hard to start spending. I mean, you've been accumulating, you've been growing that mountain, and now you gotta descend down it. And it's hard to start drawing down from those accounts and seeing balances go down.
yeah.
You try and help people do that because sometimes people are spending actually too little in retirement, and we want them to have a more fulfilling retirement.
Yeah, yeah. You can't make gifts to a family or to a charity or to anyone if you're worried about the fact, do you have enough money to meet your goals and to meet your lifestyle? And we're very fearful. We don't discuss money with our friends or family, and so fear a lot of times controls our behavior.
Yeah, absolutely. So next on there was money mistakes. Um, Often, I mean, some of these are just small mistakes too that an advisor or you yourself, once you've laid out your financial plan, you'll start seeing some of this stuff, like beneficiary designations on accounts. Those often are very outdated. Once you sat down and done your financial plan, you'll recognize, oh, this is not in line. Maybe you have too
Uh,
much funds in a checking
or
account.
tax-free bonds in your IRA account.
Yep.
That's another real common mistake I see.
Yeah, too much funds in the checking account is another one, like a
Annuities
interest. Yeah. So
or,
making
or
a
life insurance when they have no dependents.
Yep. Yep. Yeah, it's so making a financial plan, once you put it all on paper and you summarize, I think another great place to start is just creating that net worth statement will allow you to see some of these money mistakes. And then if you're doing it DIY or if you're working with an advisor, yeah, a second person can
I
review.
think number 5 is really important.
Yeah. So when you're working with an advisor, or you're doing it yourself, you want to make sure you're tracking the progress of your goals. Those goals that you outlined, are you building enough funds up for retirement? Do you have enough funds set aside for that wedding that you are having for a kid? So those making sure you're making progress on those goals, doing it yourself or doing it with an advisor.
Yeah, you should update your net worth at least, I would say, annually. You
Yeah,
know,
absolutely.
because if you were to read the news, especially this last month, you would think that we're going to hell in a handbasket, you know, but maybe your net worth hasn't changed that much.
Right. Totally.
Um, Identify risks.
Yeah, so the thing that comes to mind with identifying risks is in the financial planning process is looking at insurance, looking at your own liability insurance, whether it's your home, your auto, your umbrella policy, making sure you have enough liability coverage. Maybe some other risks too, or maybe your portfolio is too conservative. Maybe you don't have enough growth in your portfolio, and now inflation is a risk in your retirement plans. Or maybe the flip side, maybe you have a really, really aggressive portfolio and now market movements, that's an added risk to your retirement plans. Um, so yeah, just once you've made a financial plan, it'll help you identify those risks that stand out.
Yeah, and the financial plan is kind of out of date as soon as you finish it, you
It's true.
know. But if you do it and you every year and 3 to 5 years, you begin to see trends, and you've got some comparison issues, and that really helps you uh, uh, feel more comfortable with your own money.
Right. Absolutely. Yeah, I think confident and comfortable is those are 8 and 10 on this list. Those are so important. And I think once people have documented all of their assets, all their income, all their spending, put together a financial plan, it makes you more confident and comfortable, which is invaluable. So
I love that article, the 10 reasons why financial plans aren't just for the 1%.
yeah, yeah. So financial planning is not just something for people with a lot of assets. It's for everyone because regardless of your asset level, you need to put together a financial plan of what's my income, what's my assets.
Yeah, and the thing of it is that people don't like to talk about how they spend their money to another person. That's kind of,
Totally. Yeah,
like a privacy thing. And and you don't talk about it with friends. And so consequently, you only listen to it from the brokerage firm or from some other source. We're very uneducated when it comes to money.
yeah, absolutely. Yeah, and I think either seeking a second opinion or just finding ways to educate yourself are super important. I've good podcasts that I like listening to, or there's some good books out there on financial planning. But for those who are completely uninterested in those topics, I think seeking a second opinion is so important. It's just like seeking a second opinion in the medical field. I myself don't want to do the research on my own, medical situations. I'd rather trust a professional to
Yeah,
get my
yeah,
diagnosis and give me a plan.
yeah. But if you're with Merrill Lynch today and you go, gosh, I want to get a second opinion. Let me go to Morgan Stanley and get a second opinion. That's like going to your Lexus dealer and say, gosh, I want to get a second opinion on a Lexus. So let me go over to the Mercedes dealership and get a second opinion. You're going to get a very biased point of view. If you want a second opinion, go to a fee only fiduciary advisor. Let's go
Absolutely.
to the next slide.
Okay, so what is financial planning? So this is something that I think at least for myself, I had no idea all these topics were included in the financial planning process before I got into this field. I think when you first start thinking of financial planning, everyone wants to jump to the investment management, but there's so many more topics that are more important even than the investment planning itself. So some of those are the goals and assumptions. We talked about that. Cash flow and budgeting, making sure your income and expenses balance out, putting together a retirement paycheck for yourself, risk management, insurance. Do you have enough coverages in your auto, home, maybe rental insurance if you have a rental property? College savings, either saving for yourself or saving for a child or grandchild. There's many different avenues you can approach college savings, whether it's in a account titled in your own name, or maybe even there's a 529 account, which allows for tax deferred growth of college savings. So there's many options there for that. Student loan decisions. Should you be paying off? Should you be looking into programs that allow for income based payment plans? So there's a lot there. The tax planning side. I think on the tax planning side, um, often we are working with a tax preparer in our day-to-day lives. Either it's TurboTax if you're using it for yourself, or if you're actually going to a tax preparer. Um, but the tax preparer is really doing a lot of backward looking, um, uh, when they're putting together their taxes for you. So they're doing backward looking information. They're looking at last year's income, last year's income sources, whether it be Social Security, your paychecks, all those withholdings, and they're not necessarily, a tax preparer is not necessarily doing the forward-looking planning and tax planning to say, okay, my income's going to change in 10 years. Does that change what I want to be doing in this year? And so that's what a financial planner is also good for, is doing that forward-looking tax planning that then you can take to your tax preparer and say, does this make sense?
Well, think of it this way. An accountant accounts for what you have done. Very few CPAs are planners. You know, we encourage you to ask your CPA to do some planning, and you should certainly understand the tax ramifications of any investment that you make. Because whether the investment is within an IRA or 401k, or whether it's outside, it's taxes. The financial advisor fee can really be made up just in the area of tax planning alone. We're not even talking about the investment area. So if your advisor is not talking to your CPA or tax preparer, you're not getting the full benefit.
Right. So yeah, and then the investment planning, and I think something that is a good summary of this is, if just like Peter's saying, if you're working with an advisor who's really just talking to you about that line on investment planning, they're not covering all these other topics. And if they're charging you a 1% fee to just do the investment planning, there are plenty of other financial advisors out there who are doing much more work and doing much more financial planning and comprehensive planning for people. So it's something to think about if you're really just getting investment advice.
Yeah, I just don't think you can recommend an investment unless you understand the person's goals and you understand the person's cash flow.
Right. Right.
And when they may need that money.
Absolutely.
Certainly you wouldn't invest in the stock market if you need the money 6 months from now.
Absolutely. Yeah. And the other thing is, a person should be taking into account your risk tolerance. That advisor should be, either through a questionnaire, a conversation, something, helping you understand what is your actual risk tolerance for, if market movements like we're seeing right now with tariffs happening, if those market movements are scaring you, maybe you are in too risky of a portfolio.
Yeah.
Or if you're actually much more confident, maybe you can be a little bit more aggressive. But that conversation should also be had.
Yeah. And investment planning is completely different once you're retired. You can't go back. Well, most of us can't go back to work, if we lose money. So retirement planning is, all of a sudden, we're not getting a paycheck any longer. We want that investment portfolio to generate some growth and the income for the rest of our lives. So that is completely different than somebody who's 40 and 50 who are still growing their portfolio.
Right. Right.
It's you mentioned something that I found interesting as to, for retired folks, you set up their portfolio and then you give them a certain amount per month into their checking account, almost like a paycheck.
Yeah. So for people who are totally retired, we if you're working with an advisor, they should be helping you put together the replacement of a paycheck based on your needs for spending. So if we have established what your spending needs are, is this sustainable for your full retirement period? Okay, now let's understand all your income sources. Maybe you're getting Social Security, maybe a rental income from a rental property. So then after those income sources are considered, what amount do you need to take from your portfolio? And the advisor can be then just sending you that amount from the portfolio per month to supplement and create that retirement paycheck.
I think that's great, because that's what somebody needs, because it's a too big a shock to say, okay, I need 2,000 this month, I need 5,000 next month. It's you don't know where you are.
Right. And also it's about how much risk are you taking with the funds that you need in the present. So if you need, 75 to $100,000 for a year, are you accidentally leaving all of that in stock? And now it's much different over the course of time because with market movements you could be drawing down on that portfolio while the market's down. Instead, working with an advisor, they might be helping you position some of that stuff in shorter term stuff like
Yeah,
bonds or cash.
bonds and stuff. Yeah.
Yeah.
Estate planning, you review a person's estate plan and wills, trusts, beneficiary designations, etc.
Yes, yeah. So we are not estate attorneys. We are not drafting any of those documents, but we do review those documents to make sure they are aligned with the person's values, make sure nothing's out of date, especially on the beneficiary designations for retirement accounts like the 401k or the IRA. So yeah, we're reviewing people's estate plans, but we're not drafting estate plans ourselves.
Okay. There was a question on tax advice. Do you give tax advice to your clients, or how does that work?
We do not. So we give tax projections and tax recommendations for their plan purposes, but all of that is to be taken to their tax professional to have verified before they're implementing.
And it would be best if the tax professional talked to you directly.
Yeah, yeah. So we can talk to a tax professional, and we can also just we do tax projections in a software. We have an output from that software, and that can just be given directly to a tax professional for them to verify if it all makes sense.
There is no one person that knows everything. So, it's I describe a financial planner such as Thomas as being the family doctor, the one that's kind of a gatekeeper. Hey, you need a specialist in your knees, or you need a specialist for cancer, or that type of thing. It, they're the ones that kind of keep it all together. Give you a blood test every once in a while, see how your blood pressure is on an annual basis, see where your money is going, and just making sure you're normally healthy as far as your money is concerned. But you need a team. If especially for if you have a higher net worth, you need that tax person, you need that insurance person, you need that legal help, and they should all be working together. And if they're not talking to one another, you're not getting the full benefit.
Yeah, I like that analogy a lot. All right, should we go to the next slide?
Yep.
So this is a good self-assessment quiz to chew on and ask yourself these questions about how much you're going to need in the future. So if you're looking to retire soon, how much are you going to need at retirement? How much do you plan to spend throughout retirement? And that'll help dictate how much you need to retire on. Do you need to set aside funds for education funding? How much is that going to be? That might be is it a long-term goal? Like, is it a grandkid and there's, 18 years to help fund this? Or is it a much shorter term? Other lifestyle goals like travel, how much do you need for things like, yeah, traveling or car replacements, long-term care funding? So setting aside those putting together the goals and then putting the amounts that you need for each of them is super important. The next question on there, are your investments properly diversified, and is the strategy appropriate for you? So you want to be using ideally low cost, really well diversified investment products. And there are plenty of companies out there that do provide those types of products. But I would caution against doing anything like picking individual stocks, especially if your individual stock is tied to your employer. So let's say you've been working at Apple for many years and you have accumulated a bunch of Apple stock. Well, now both your income and your investments are all tied to one company. So that adds risk to your financial plans. So looking at your investments and asking yourself, are they properly diversified? Do I have enough investment companies? Am I diversified across countries, not just the US? Do I also have international? Do I have bonds in my portfolio? Because maybe you don't need only stocks in your portfolio. Maybe you also need bonds.
Yeah. Hey, diversification, diversification, diversification. It's like real estate, location, location, location. Diversification is safety. Yeah, there's no one around, uh, Kramer or anyone else that can predict the future. And so you want to be diversified. And it's especially as we get older. Carnegie said that if you want to get wealthy, buy one stock and watch it carefully. Well, as you get older, the opposite is true. Okay. You want safety is much more important than making a killing on one stock.
Right. And there's a lot of people out there who will act like they're confident enough to be able to predict these types of things, whether it's market movements, timing the market, individual stocks themselves. But all of the financial data that's out there points to the fact that it is really, really, really hard to do to predict anything in the financial markets, and that buying low cost, really well diversified index funds is going to beat, 90% of all other types of funds that you could be purchasing.
In your practice, when you get to the investment part, what funds do you use?
Yeah, so we use Vanguard's low cost index funds. We have a few of them between like large cap stocks, small cap stocks, their bond positions, and then we're using treasury positions as well.
Okay. And the reason why you do that is because Vanguard offers very low cost, efficient funds, and they don't charge a commission.
Yeah, they don't charge a commission, and their fees are ridiculously low for the product that they're providing.
Yeah.
They're in the 3.03%, so 3 basis point area for a lot of their funds, which is ridiculously cheap for what they're constructing.
Yeah. When we talk basis points, what do we mean by that?
Yeah, so one basis point would be 1/100th of a percentage.
So 100 basis points would be 1%.
Correct. Yeah.
Okay.
So 3 basis points is 3/100ths of a percent.
Yeah.
That's all that's being charged on those types of funds.
Yeah.
So,
and they're out there. Out of the 20,000 mutual funds, there are really good funds out there. And if you're with Vanguard, congratulate yourself. You're one of the best fund families. I just hope I don't ever see Vanguard funds on the front page having done something nasty,
Yeah. They do have some active funds at Vanguard.
Yeah.
So it's not that every Vanguard fund is the best thing in the world, but they, for the most part, have a lot of really good low cost index funds that.
Let's go to the next slide.
Yeah. So now we'll talk about developing a financial plan. So place to start is examining your current situation, whether you're doing this yourself or you're doing this with an advisor. So just setting the table, setting all the financial goals. When you
measure your progress, see what your net worth is over a 5-year period. Are
right.
If you're in the growth area of your life, make sure you know how much progress are you making on an annual basis. If you're in the latter stages of your life where you're decreasing your portfolio, make sure you understand that. You don't want to go from You don't want to dive from a cliff. You want it to be, you want your decline to be gradual as far as your net worth is concerned.
Right, right. And then when you're working with an advisor, they should be doing that top bullet there, which is examining your current situation before they're making any type of recommendation to you. They should be fully understanding who you are, what you value, what your age is, your children if you have them, your family dynamics. All of that should be understood by the advisor before making a recommendation. If you're working with someone and they're making a recommendation the very first meeting you meet with them, it's probably not a great advisor to work with. So you want someone who's going to understand you first.
Go to the next slide.
Okay, so this is the CFP board outline the financial planning process. I won't spend too much time on this slide because the rest of the slides cover each of these seven. But it's just important to know that there is a standard that certified financial planners follow when they're doing the financial planning process with clients, and they follow these 7 steps.
And it takes time.
Yeah, it takes time.
It doesn't happen on your first meeting. Probably 3 to 5 meetings to get there.
Yeah. So this is the first side, establishing the relationship with the CFP professional. We were talking about this earlier as being one of the most important things, that rapport, that trust. So it starts with that ask first form that has been developed. Using that to understand how the advisor gets paid, their experience in this field, how long they've been working as an advisor, how they're compensated. All those things are super important to start with. And then next is when you're talking with them, they're going to try and ideally be getting to know you and understanding your background. You'll probably be getting to know their background, and you want to know or start digesting like that communication back and forth. Do you agree with their communication style? Do you like working with that person? Do you feel that that person is trustworthy and is going to be looking out in your best interests? Or are they going to be looking out in the interests of the place that they're working for? So all of that is super important just to set the baseline before even getting into the financial planning.
Next slide.
So this is understanding the personal financial circumstances, asking questions about their life, money history, their family, any of their interests, their hobbies, the assets and liabilities, helping put together that net worth statement. Oftentimes it is like a very first thing to do just to help give clarity to what do you own and what do you have debts for. And that's a great just like eye-opening process for a lot of people
Yeah,
because
and if you're doing it yourself, go ask a bookkeeper or a CPA to help you put a net worth statement together. Each one of us should have one. When I was with Long Beach State University and asked professors and staff, no one, almost maybe 1 out of 10, had an idea about their net worth. But it's really important.
it's super important. And then the other on there is the reason you're meeting with the planner. Often the advisor is going to be asking you that because we want to know what is the thing that's nagging at you? What's the thing that's causing you to lose sleep? What's the most important financial planning topic to you right now? When we're doing financial planning for someone, of course we want to do comprehensive. We want to cover all the topics of financial planning, but it's really important to start at least with what is most important to you right now. And then also on there is the decision-making communication preferences. That should be talked about because
You want Zoom, you want telephone, you want in person, you want letters,
yeah, and the frequency. How often do
yeah.
you want to meet? How often do you want to hear from me via email? Yeah, that should be talked about.
Let's go to the next slide. By the way,
Identifying,
we've got a little over 10 minutes there, Thomas. So I think many of these we could shorten a little bit.
totally agree. So some of this we've talked about identifying, selecting goals. Down there at the bottoms, the other important one is the planner's going to discuss with you the assumptions that they're using, life expectancy, inflation rates, tax rates, the investment returns, so that should all get communicated with you, and because those are the things that are going to be used to create your financial plan.
And the nice thing about having a financial plan is the number crunching exercise. So you can do what ifs. You say, what if my portfolio goes down 20% in any one year? What if I move? Or what if I spend an extra 200,000 in one year? It allows you to see what will happen to your money.
Absolutely. Okay, I'll keep going here. Analyzing the current course of action, potential alternative course of action. So that's Peter was just hitting the nail on the head there with the what if scenarios. So we're kind of starting, okay, this is where you're at, this is where you're headed. Now, what if you saved a little bit more? What if you spent maybe a little bit less in retirement? What if you retired a little bit later? What if you were able to retire sooner because you actually have much more funding than you thought you had?
Yeah.
So
That's
that,
where your engineering background comes
yeah,
into play.
the
Let's
engineering
get the numbers done.
plus the power of the financial planning softwares that are out
Yeah,
there. There
it's
is
huge.
some really powerful software
Yeah, but
that we're not seeing.
if you put garbage in, you get garbage out. So you got to make sure you get the right numbers that you put in there. Let's go to the next slide.
So next is the professional. Now, after they've understood who you are, talked about all the assumptions that they're going to make in the software, talk through all your goals and put them into a planning software, then they're going to start giving you those recommendations. So I think like Peter was saying, it's a process. It's not like Snap and there's the financial planning is done. There is like a time period that goes on when building these financial plans. You don't want to rush through this.
Yeah, the number one question I get at the workshop series is somebody coming up to me afterwards and say, I have blah, blah, blah as an investment. What do you think? I have no clue. I don't know what their goals are. I don't know what their tax bracket is. I don't know what they're spending on an annual basis, et cetera, et cetera.
They're trying
It's
to skip three
impossible to
steps.
give an answer to somebody like that
Yeah.
unless they have an annuity. More likely you could say, more than likely it's not appropriate for you. But let's go to the next slide.
Yeah. So next is presenting these recommendations. So the advisor will then have done the analysis, and then you'll have a meeting, whether it be a Zoom, in-person, phone call, where the advisor is going to present these recommendations and then give you ideally a list of things to do, like your next steps. You either need to you should be changing the titling of this account because you have a trust and this account is not titled in the name of your trust. You should be, you have too much funds in your checking account. What if we do a high yield savings account? Maybe we want you to save more. So let's set up some automatic saving coming from your checking account and moved over to this account.
Yeah. Or
So,
you don't have enough bonds in your portfolio for fixed income. You're kind of out of whack there. You're taking too much risk for what you're needing. You
right.
know, the financial advisor, from my point of view, it's kind of like trying to get that, if you play tennis, trying to get that sweet spot where the ball hits the racket, and there's a sweet spot. And your financial advisor is there to get your money invested in that sweet spot where you got enough for the rest of your life, but you're not taking too much risk to where you've got a great risk to lose your money. It's part engineering and it's part art. There's it's not all science because we're humans.
Yeah. Yeah.
We're kind of weird.
It's a blend.
Yeah.
All right, I'll go next. And then the implementing. So this is something that you should address with your advisor, or at least the advisor should address with you. Who is going to be doing the implementing of those recommendations? Is it the advisor, like in a situation where the advisor is managing your assets? They might be recommending, hey, we should change the portfolio. And after you approve that decision, the advisor is going to be the one who makes that change to the portfolio because they're managing your assets. But in other cases, like let's say it's a state recommendation, like the advisor saying you have a lot of assets that you should be having a trust. The
Or
advisor's
you
not
need to change title.
Yeah, the advisor's not going to be one doing that. They're not going to be implementing that decision.
But
That'd be
they're there to harangue you to make sure that you do it.
yes, a lot of bugging happens.
Yes.
A lot of poking, that's for sure.
7. Next slide.
And then this is the last one. So this is depending on the type of engagement that you have. If it's a short-term engagement, there may not be a step 7. There may not be progress benchmarked from your advisor. If it's
What does benchmarking mean?
So in this case, benchmarking the goals would mean just making sure your goals are on track. But I think what you're getting at is benchmarking investments.
Yes.
So benchmarking investments would be comparing your investment allocation toward a index and seeing how those two compare over time and seeing if your investments are performing above or below that index and seeing if maybe there's too many fees in this investment product. Maybe the investment selection itself is actively managed and not performing as well as the index. So it's comparing your investments against some type of.
Yeah. I get a lot of comments saying, my mutual fund got me X return. And they're very happy with that X return. And my question is also, how did the benchmark do comparatively to your mutual fund? So let's say your mutual fund got an 8% return, but the benchmark got a 15% return. Well, the benchmark is probably a index fund, no expenses, no fees. So your 8% is not very good. So naming a number or a percentage doesn't give you enough information as to how well your fund has done. You need a benchmark in order to do so.
Right.
One of your common questions, I bet, is how much money can you make me, Thomas?
That does happen a lot. So we talk about expected returns, but returns themselves are obviously going to vary around. So we don't have a crystal ball that says I can guarantee you that you're going to get a 6% return over your whole retirement. There is no guarantee, but we forecast what we think could happen, and we vary that in a retirement plan because we know returns are going to vary over time. And that's how we kind of stress test a retirement plan to make sure it's going to sustain itself for the full retirement period.
Yeah. And another thing about a financial advisor, and I recommend this especially for individuals who've had a spouse that has who has been deceased and you're on your own, meet with a financial advisor, a fee-only advisor, so they can help you prevent you at least from making the big mistake, falling for a scam, lending somebody money that you may not know. One of your children wants a ton of money from you. It's also just helps you feel comfortable that you're doing it the right way.
Yep, absolutely.
Is that your last slide there, Thomas?
Yep.
All right. Perfect.